Hi friends, welcome back. My name is Pavan Kumar representing CAP classes. We are discussing Accounting Standard 10, Property, Plant and Equipment. In our previous videos, we have discussed about the applicability of Accounting Standard 10, where Accounting Standard 10 PP is applicable and not applicable we have discussed, and we have discussed also certain things like biological assets, what is a biological asset, what is a bearer plant, what is a living animal, when Accounting Standard is applicable, when Accounting Standard is not applicable, everything we discussed in previous slides. Now in this current video we are going to discuss a very important thing, the recognition principle of property, plant and equipment. Initially, we need to understand what is meant by recognition. We have studied Accounting Standard 9, revenue recognition. What is the meaning of revenue recognition? It simply means when a journal entry recognizing the sale can be recorded in my books of account. That means I have sold goods. When can I recognize the sale? When can I pass the journal entry cash account or debtor account debit to sales account? That is recognition. So applying the same principle to property, plant and equipment, what is the meaning of recognition principle, recognition timing here? That means when can I pass a journal entry in my books of account recognizing the transaction of sale? That is what we are going to discuss in this recognition principle. Accounting Standard 10 says there are 2 points to be considered before recognizing. These 2 points are known as recognition criteria. What is that? Point number one. Before recognizing certain thing as property, plant and equipment, that is a fixed asset in your books of account, what you need to check is whether the enterprise is going to get future economic benefits flowing into the organization because of this PPE. If the answer is yes, this meets the recognition criteria. If there is no future economic benefit flowing inside the entity because of this cost incurred, that is not going to be capitalized, it is going to be expensed off. So first one is future economic benefits. Second one is whether the cost what you have incurred, can it be measured reliably. This is the second criteria. So first criteria is whether there is a future economic benefit. Second criteria is whether the cost incurred can be measured reliably. And the most important point here, what we need to understand is the criteria must be met on the date when we are incurring cost. For example, if you observe, though not relevant for Accounting Standard 10, I will tell you one principle here. Research and development expenditure. Previously it was Accounting Standard 8 long back. After that now it is covered in Accounting Standard 26. So Accounting Standard 26 clearly says research and development expenditure treatment. Now in research and development expenditure, research cost, whatever the amount of expenditure you have incurred towards research of the product, towards research of that particular technology, towards research of that particular platform, whatever the volume of money you have spent, irrespective of the amount, even if it is 100 crores, 1000 crores, 1 lakh crores also, research cost should be expensed off to P&L account, should be charged off to P&L account. Development cost can be capitalized. This is what Accounting Standard says. Now we need to understand why. Because the day when you are incurring cost towards research, the future economic benefits are not certain. When research and development expenditure, whatever the money you have spent, if research is successful, then you may foresee some economic benefit out of that expenditure you have incurred. But if it is not successful, all the money is waste. You need to write it off to P&L account. So the date on which you are spending the money, on that date you need to check whether there is a future economic benefit. When I am spending money towards research and development cost, there is no economic benefit, so expense it off to P&L. Applying the same principle to Accounting Standard 10, I'll give you a very appropriate example with which you can easily understand when to recognize it as an asset, when not to recognize it as an asset. For example, director of a company, he went on for a foreign travel. A director, one Mr. A representing X Limited, who is director of X Limited, he went to USA to verify one machine. If the machine meets their specifications, he wants to order the machine. Otherwise, he will come back and they will search for another supplier. So the company has spent, say for example, 10 lakh rupees of money for director's travel expenditure, director's foreign travel expenditure, so that this director will go to United States, he will see the machine with the supplier, and if it meets all their specifications, their intended use, then they want to order. Whether the company is going to purchase the machine or no, whether the machine is satisfying their criteria or no, irrespective of the fact, this director's traveling expenditure money, 10 lakh rupees, should be written off to P&L account, can never be capitalized because of one simple logic. When you are spending money, there is no future economic benefit expected of it, so it cannot be recognized as an asset. So it is simple. We have discussed recognition principle of property, plant and equipment in Accounting Standard 10. In this video, the summary is: an item of expenditure, an item of cost incurred towards property, plant and equipment can be capitalized only if it satisfies two conditions. Condition number one, whether this amount spent gives you future economic benefits. Two, can it be reliably measured? If both the conditions are satisfied, capitalize the cost, otherwise charge it off to your P&L account. As simple as this. Thanks for watching our video. Hope you are enjoying CAP classes videos. If you like it, please like it here. Please share it and please subscribe to our video channel in YouTube. Thank you so much. In the next video, we'll be discussing accounting treatment of PPA. Thank you.